Learn how tax deductions work legally in the United States. Tax deductions in the United States work by allowing individuals and businesses to reduce their taxable income, thereby lowering the amount of income subject to taxation. Deductions are legally permitted under the U.S. tax code, and they help taxpayers reduce their overall tax liability. Here's how tax deductions work legally in the U.S. Eligibility criteria. Tax deductions are available for specific expenses that meet certain eligibility criteria established by the Internal Revenue Service, IRS. Deductions are categorized into various types, including personal deductions, business deductions, and itemized deductions. Personal deductions. Personal deductions are expenses that individual taxpayers can deduct from their taxable income. Common personal deductions include the standard deduction, which is a set amount determined by the IRS, and exemptions for yourself, your spouse, and dependents. Business deductions. Business deductions apply to eligible expenses incurred by self-employed individuals, sole proprietors, partnerships, corporations, and other businesses. Businesses can deduct expenses necessary for the operation of the business, such as employee salaries, office rent, utilities, and office supplies. Itemized deductions. Itemized deductions are expenses that can be claimed individually rather than taking the standard deduction. Common itemized deductions include mortgage interest, deduction for interest paid on a qualified mortgage for a primary and secondary residence. State and local taxes, deduction for state income taxes or state and local sales taxes paid. Medical expenses, deduction for medical expenses exceeding a certain percentage of your adjusted gross income, AGI. Charitable contributions, deduction for donations to qualified charitable organizations. Education expenses, deductions for qualified education expenses, such as student loan interest and tuition. Casualty and theft losses, deduction for losses resulting from unexpected events like natural disasters or theft. Record keeping. To claim deductions, taxpayers must maintain accurate records and documentation of eligible expenses, including receipts, invoices, and supporting documentation. Tax filing. Deductions are claimed on your annual income tax return, typically on Schedule A for itemized deductions or specific sections for personal and business deductions. You can choose to take the standard deduction or itemized deductions, whichever results in a lower tax liability. Tax benefits. Deductions reduce your taxable income, leading to a lower tax liability. For example, if your taxable income is $50,000 and you have $5,000 in eligible deductions, your taxable income for tax purposes becomes $45,000. Limits and phase-outs. Some deductions may have limits or phase-outs based on factors like income, filing status, and the nature of the expense. It's essential to understand these limitations to maximize the benefit of deductions. Tax professionals. Many taxpayers seek the assistance of tax professionals, such as certified public accountants, CPAs, or tax advisors, to ensure accurate deduction claims and compliance with tax laws. IRS audits and compliance. The IRS conducts audits to verify the accuracy of deduction claims. It's crucial to maintain proper records and documentation to support your deductions in case of an audit. Tax deductions are a valuable tool for reducing your tax liability legally. However, it's essential to understand the specific rules and requirements associated with each deduction to ensure compliance with tax laws. Consulting with a tax professional can be beneficial in navigating the complexities of tax deductions and maximizing your tax benefits. For more videos, don't forget to like, share, and subscribe.